Hi, in today's class I am going to solve the second part of problem number 10. In the first part I have solved the first three houses of problem number 10. In the second part I am going to solve the remaining house properties. Let me solve the fourth house. The fourth house is a let out property and it was let out at rupees 700 per month in the previous year. So we will assess it as per the provisions of let out property. Annual municipal value is 8,000 for the fourth house, and standard rent and fair rental value not applicable. So therefore municipal value itself is a expected rental value. Next is the rent received. The rent received is 700. It was let out at rupees 700 per month. So into 12, so 8,400 is a rent received. And unrealized rent not applicable, no vacancy period. So actual rent received for the let out duration is 8,400. Next, gross annual value. Since there is no vacancy period and unrealized rent, so expected rental value or rent received, whichever is the highest, is a gross annual value. Higher of these two is a gross annual value. 8,000 or 8,400, whichever is the highest is gross annual value. So here it is a 8,400. Next is a municipal tax paid. Municipal tax paid for the fourth house is a 10% of its municipal value. So 8,000 is a municipal value into 10%, 800. So in the problem it's given or it's specified that municipal taxes assessed and paid at 10% of municipal valuation. So municipal value of this house is 8,000 and it into 10%. So 800 is a municipal tax. So balance 7,600 is a net annual value. 8,400 minus 1,800, sorry, minus 800, the balance is a 7,600 is a net annual value. Next, deduction under section 24. The first one is a standard deduction and another one is a interest on loan. The standard deduction is a 30% on a net annual value. So here net annual value is 7,600. 7,600 into 30%. You will get a 2,280 as a standard deduction. Next, interest on loan is a nil because the loan is not borrowed or no details regarding the loan of 4,000. So therefore it is considered as a nil. So after deducting standard deduction from net annual value, you are going to get the 5,320 as a income of 4,000. 7,600 minus 2,280. So balance is a 5,320 is the income of 4,000. So this is the solution for the fourth house. Now I am going to assess fifth house, and again fifth house is also let out property. It has been let out at rupees 1,200 per month in the previous year. So we will assess it as per the provision of a let out property. Begin with the annual municipal value. It is 12,000 of fifth house. Fair rent and standard rent not applicable. So therefore expected rental value is a 12,000 is our expected rental value. Next is a rent received. So it has been let out at rupees 1,200 per month let out. So rent of the house is 1,200 and there are 2 months vacancy in case of fifth house. The fifth house vacant for 2 months. The vacancy period, there is a vacancy period in case of fifth house. So therefore rent received is for 10 months. 12 minus 2 months vacancy period. So you are going to get actual let out duration of the fifth house is 10 months. So therefore rent received for let out duration is 12,000. 2 months is a vacancy period. So therefore the let out duration of the fifth house is 10 month. And no unrealized rent. So total rent received for the let out period in case of fifth house is 12,000. So next, gross annual value. Since there is a vacancy period, rent received itself is a gross annual value. No comparison. Because of vacancy period, gross annual value is equal to rent received. Next is the municipal tax. It is a 10% of annual municipal value. So municipal value is 12,000. 12,000 into 10%. So 1,200 is the municipal tax. So next is the net annual value. Gross annual value minus municipal tax paid. 12,000 minus 1,200. So 10,800 is a net annual value. Next is the deduction under section 24. The first one is a standard deduction and second one is a interest on loan. The standard deduction is a 30% on net annual value. So net annual value is 10,800. So 10,800 into 30%. So you are going to get 3,240 as a standard deduction. Next is a interest on loan. So here in case of fifth house, SSC has borrowed rupees 3 lakh as a loan for the construction of this house, and rate of interest is 10%, and construction was begun on 1st June 2016. That is the date when the loan was borrowed, and the construction completed on 31st January 2019. So there is a loan borrowed, or SSC borrowed the loan for the construction of the fifth house. So therefore we have to give the deduction under section 24 under the category of interest on loan. So there are two divisions, 1/5 of PCP interest and another is interest on loan in previous year. That calculation I have showed in a separate slide. So later I will explain it in another slide. So 1/5 of PCP interest you are going to get 11,000 after calculation, and interest on loan in previous year is 20,000. So total interest on loan for the SSC is 31,000. So this is eligible amount for deduction. So SSC is going to get 31,000 as a deduction. So from net annual value there are two deduction. One is this standard deduction and the second one is interest on loan. So total after deducting both standard deduction and interest on loan from a net annual value, here there is a loss of 23,440. So loss in case of fifth house, SSC is going to get the loss in case of fifth house, and that loss is 23,440. In another slide, I am going to explain the calculation related to interest on loan. Here I am going to explain about how the interest on loan to be calculated for the let out property or for self-occupied property, and whenever there is a loan information or whenever there is a loan borrowed for the construction of any house. So here also in the case of fifth house, SSC borrowed rupees 3 lakh for the construction of fifth house, and he borrowed it on 1st June 2016, and that is the date on which the construction also began, and on the same date the loan also borrowed, and construction completed on 31st January 2019. And another information, the interest paid by him for the previous year was rupees 20,000. So with the help of these details, we have to calculate interest on loan for the interest on loan for deduction. In two division under interest on loan, the first one is a 1/5 of PCP interest and another is a interest on loan in previous year. Let me calculate the first part. First part is a 1/5 of PCP interest. PCP stands for a pre-construction period. It means the period from borrowing money until 31st March immediately preceding the year of completion of construction of the house is called pre-construction period. It means the pre-construction period means it starts on the date on which the loan borrowed and end on 31st March prior to the date on which the construction completed. I repeat, the PCP means the date on which the loan borrowed and end on 31st March prior to the date on which the construction of house property completed. So as per this, for the calculation of PCP, you need the date on which loan borrowed and the date of construction completed. With the help of these two, you have to find out PCP. PCP is a duration. It's a pre-construction period. The term before the term which has been used by the SSC for the construction of the house. The term before completion of the duration, the period which has been taken to construct the house, that is called as a pre-construction duration. So for that there is a formula for to find out 1/5 of PCP interest. The formula is, our equation is loan amount into interest, rate of interest into PCP. PCP is the duration of construction divided by 12 into 1/5, and 1/5 because the interest can be pre-construction period interest can be paid in 5 equal annual installments. So then only SSC gets the deduction. If installment crossed more than 5 years, then SSC not eligible for deduction. First part, loan amount. Loan amount is given in the problem 3 lakh. The second part, interest. Interest is 10%, which is also specified in the problem. 10% is the interest. Now the PCP, pre-construction duration, which you have to calculate with the help of date of loan borrowed and the date of construction completed. See here, the date of loan borrowed is on 1st June 2016. That is the beginning date for PCP, pre-construction period. And the construction completed on 31st March. The construction completed on 31st January 2019. Here I have written it as 2018, not 2018. The construction completed on 31st January 2019. So that is the date of construction completed. Loan borrowed on 1st June 2016, whereas the construction completed on January 2019, 31st January 2019. Now the PCP starts on the date on which loan borrowed, that is from 1st June 2016 till 31st March prior to the date on which the construction completed. Previous 31st March to this particular date, to the date on which construction completed. So till 31st March 2018, not 2019. 2019 is the next day, a month. Previous March to the January 2019. So till March 2018, you have to find out the PCP. The total months, 22 months. It's from 1st June 2016 to 31st March 2018. The total PCP duration is 22 months. So that is which you have to apply here. 22/12, that's a PCP, and into 1/5, 5 equal annual installments. So total interest paid, total amount for deduction under the category of 1/5 of PCP interest is 11,000. 11,000 is 1/5 of PCP interest which is liable for deduction. And the second part is interest on loan in previous year. The equation for this deduction is outstanding loan in previous year into interest. But in this problem, the interest on loan for the previous year has been specified. So it's clearly mentioned that for the previous year, the interest paid by him amounted to rupees 20,000. So it is directly given. The interest on loan for the previous year is directly given, that is rupees 20,000. No need to apply this particular equation or no need to find out the interest on loan in previous year because it has been given in the problem. If it has not been given, then you have to calculate by applying this particular equation. So here you have to calculate only one first part, that is 1/5 of PCP interest. The second part of interest on loan is given in the problem itself. So total deduction for interest on loan is 31,000, which I have showed in the previous slide in the format. So that's all about the calculation of interest on loan. This is the grand total of 5 houses. First house self-occupied, no income. Second house used by SSC for own business, so therefore not applicable under income from house property. Third house, it has two part. First part, 2/3 part, which is let out property, and there SSC got the income of rupees 6,160. And in case of self-occupied property, no income, it's nil. And next is a fourth house let out property, its income is 5,320. And fifth house income is 23,440. There is a loss, sorry, in case of fifth house SSC is got the loss of 23,440. in case of fifth house it's a minus 23,440. So after set off of this loss, the loss SSC gets the total loss of rupees 11,960 is a loss. In case of 5 houses, the SSC is going to get the loss of rupees 11,960. And in the problem there is one statement which I explained in the beginning itself while explaining the problem. During the year, SSC recovered the unrealized rent of rupees 5,000, which was claimed as deduction in 2015-16. So there is a unrealized rent, recovery of unrealized rent related to 2015-16, not the present year unrealized rent. Recovery of unrealized rent related to preceding previous year is considered as a income for the current year. For the previous year, it is considered as an income. If any unrealized rent of preceding previous year, if it is recovered in this previous year, is considered as an income, and that has to be adjusted with the income or loss of the present year. So add recovery of unrealized rent of 2015-16, that is the 5,000. So after considering this SSC, this income, the SSC is going to get the loss of rupees 6,960, 11,960. This is a loss. Then 5,000 income, which has related to unrealized rent of preceding previous year. So after that, SSC's loss has been reduced to 6,960. So this is a solution for problem number 10. Thank you very much.